Hello, everyone. Thank you for joining us for a quick roundtable discussion on market dynamics and our economic outlook following the recent presidential election. My name is Ben Pease. I'm Managing Director of Fixed Income and Chief Innovation Officer here at Cumberland Advisors. With me today are David Burson, Chief U.S. Economist, John Musso, Director of Fixed Income, and Matt McAleer, President of Private Wealth. Gentlemen, my objective today is for us to focus on three primary topics. First and foremost, the state of the economy. Second, our views on upcoming policy under a Trump presidency. And third, how those policies impact our outlook for 2025. So I guess, why don't we go ahead and start off with a quick baseline. David, can you touch on the economy from your perspective as we went into the election?
Sure, Ben. The economy over the course of the last 2 years has been growing at a decent pace, but slowing, not slowing rapidly, but slowing modestly. At the same time, inflation was coming down, and it had come down pretty rapidly in 2023 and the first part of 2024. But just as the economy stabilized, so growth was stable, didn't really move down much going into the election. Inflation also stabilized going into the election. So we had fairly stable growth at an above trend pace and stable inflation at a pace still above, but not much above, the Fed's long-term goal of 2%. Now, that still means prices were well above where they were before COVID hit. And we know that had an impact on the election results. People said that. But inflation clearly had been slowing until just before the election when it flattened out. The Fed responded to all this by saying, monetary policy that was relatively tight was fine when the economy was growing very rapidly. But with inflation moving down, the economy slowing, we didn't need to be quite as tight. So the Fed said, we're going to lower interest rates to a more neutral level. And they did that by cutting monetary policy, by cutting the federal funds rate by 50 basis points in mid-September, just slightly before the election occurred. And that was a pretty big drop for a first cut, but a cut nonetheless. And the Fed tells us that they plan to continue to cut. But we had that 50 basis point cut right before the election.
Thanks, David. So great summary there. John, so David just mentioned that 50 basis point cut from the Fed. Now, I know you've spent some time looking at historical Treasury reactions after the first Fed cut in a cycle, because frankly, I hear you talking to a lot of clients about it recently. I think it's pretty interesting. Would you mind just touching on that for this audience?
Sure thing. What Ben means is that when you've had past cycles where the Fed has started a rate cutting cycle, whether they start with 50, 25, doesn't matter, but they're starting a rate cutting cycle. Either longer term rates stay where they are or go down. That has been really the pattern for many, many, many years. This time it's different. And we have one chart here to show you, and it charts the 10-year bond yield along with the basic, if you will, betting pools on Donald Trump becoming president. And it goes all the way back to basically the beginning of July, right after that first disastrous debate that President Biden had. And you can see how Trump had very high odds of becoming president. And then as the Democrats switched candidates and they went on to have a convention, you can see those odds drop. And as those odds dropped, you saw suddenly long-term yields start to come down. And you really got to September 18th when the Fed finally did cut rates, and the 10-year bond was a 370. Since then, it climbed, and you can see it climb all the way to the election. And it was right along the lines that we just spoke about, except the other side. Trump's odds were increasing, and the market started to basically perceive that we might have higher yields, because we did get higher yields when Trump was elected in 2016. Trump's spending that could be considered inflationary, particularly if you have both the House the Senate and the White House all on the same side, which it appears we have, even though they're still counting the votes in the House. It looks like it'll be a Republican House. And when they have everybody on the same side, the perception also gets heightened that, boy, it's easier to get spending bills passed, and that could be inflationary. So that's taken it higher. What's interesting is that since the election, yields have come down a smidge, but they're still pretty high. Call it a 430, 435 on the 10-year bond as we speak. The second chart shows that 10-year bond yield basically over the last few years, prior to COVID and then to now, versus trailing CPI, headline CPI. And you can see on this chart how inflation really went very high back in the days when the Fed was calling it transitory, came back down, bond yields came higher, and actually went higher than inflation. And then, of course, you started to see inflation come down and bond yields started to come down. This recent uptick makes bond yields, in our opinion, certainly more attractive than they were just a month and a half ago because yields are higher and inflation is not higher. We have two inflation numbers coming out this week, CPI and PPI. You'll have another set of inflation numbers come out before the Fed meets next. But, our feeling is that the rise in rates that you might have expected to see under a Trump presidency, the market's probably giving you the lion's share of that already.
Yeah, so the polls definitely took us for a wild ride. And I know we've talked about it and we were watching the election very closely as an investment committee. And we had come to the conclusion that there were really two higher probability scenarios that had kind of showed up. First was that we believe the Senate was going to go Republican and that Congress would likely lean the direction of the president-elect. So that really put us kind of to two scenarios that we were trying to price. I think the market was trying to price it too, and that was a Harris presidency with a Democrat Congress and a Republican Senate, or the other was the Trump red sweep. And as John mentioned, even though it hasn't officially been called, it's looking increasingly clear it's going to be the red sweep. So we have to look at policy now. What does that look like? What does it mean? So David, what economic policies has President Trump indicated he will execute on?
Well, there are really four areas in which the president-elect has said he wants to concentrate. First is immigration. The president has said that illegal immigration needs to stop and that the illegal immigrants that are here need to go back to, somewhere, perhaps their country of origin, perhaps somewhere else, but they need to leave the country. That's number one. Number two, tariffs. The president views international trade, particularly from China, as fundamentally unfair and wants to raise tariffs, taxes on the goods and the goods that they sell to us, primarily from China, but not just China, also Mexico, and perhaps even the rest of the world. So tariffs are number two. Number three, taxes. And first with taxes is to extend, perhaps permanently, the tax cuts that we saw in 2017. But the president-elect has also talked about cutting capital gains taxes further. And then fourth is regulatory policy. The incoming administration views the current administration as being overzealous with regulation, wants to cut back on many of the regulatory policies that the Biden administration has put in place and deregulate further. And I think that will probably take the form mostly of cutting regulation on energy production. So those are the four big areas that the president-elect has said he wants to concentrate on.
And David, you were just recently quoted in Money Moves as saying, the further you look out, the fuzzier the crystal ball becomes. So I guess just focusing then on 2025 and those policies, has your outlook changed for the economy in 2025?
Well, the outlook has changed some, and it's still very uncertain because, forecasts are always uncertain, but because we don't know the extent to which Trump's proposals will, or what he said will become proposals, and then which of those will be passed and in what form. Will we actually get rid of 10 million illegal immigrants in the United States? It seems impossible in a real sense to do that, but Will the administration make an attempt to remove as many as they can, or will there just be a small amount? Will tariffs go up modestly, or will they go up by a lot? The tax side, I think we're pretty sure of, and the regulatory side, I think we're pretty sure of. So the uncertainty really comes from immigration and tariffs. Having said that, all of these things will take a while to put into place. They're not going to happen on day one. So the impact on the economy in 2025 is likely to be relatively modest. And in the near term, the impact from changing regulatory policy, easing of regulatory burdens, and the extension of the tax cuts may play a bigger role than what would be economically negative impacts from immigration and tariffs. So we expect growth in 2025 not to be very different from where we saw it before. Growth of about 2.5%. Inflation perhaps just a touch higher because we will get some increase in tariffs. And interest rates still moving down, including the Fed continuing to cut interest rates in 2025, although perhaps less than they had planned to before, given that if Trump does put in the full tariff increases that he has talked about, that could be significantly inflationary. And so the Fed, not knowing what's going to pass, will still cut, but by less. So a reduction in interest rates, but by less than before, and not much change in our previous view of economic growth of about 2.5%.
Okay, so let's put a pin in that. We'll talk a little bit more about the economy in a moment, and I definitely want to get into kind of the post-election outlook for bonds. But it's really hard not to mention equities. They've been really incredible this year. I kind of want to pull Matt in here. Did you feel like the polls were having the same level of volatility and impact on the equity market? I mean, we talked about that impact and that volatility we saw in fixed income. What's your perception of kind of how the equity market was flowing?
Yeah, if we look back to October, which is the 4 weeks preceding the election, volatility was fairly muted. The VIX stayed in a fairly tight range. Markets traded around unchanged for most of October. S&P finished down half a point, a little more pressure on the international equity markets. So the markets, perhaps that was showing, some hesitation to make a bet one way or another. The thing that jumped out at me the 2-3 days prior to the election was the extreme positioning. And let's never take our eyes off the fact that we can talk about GDP, we can talk about the economy, we can talk about tax rates, we can talk about all sorts of macro things, and it all boils down to where is the market positioned for these events. And the 2 to 3 days prior to the election, there was some extreme positioning in the put-call ratio, showing that investors, traders were hedging their portfolios. The equity-only put-call ratio moved, to what I consider a high, if not an extreme, certainly high. And I think that's what you started to see election evening, right? You're hedging a portfolio through the options market or the futures market, right? And when you started to see polls and results come in towards Trump heavily, even in states where he was losing, he wasn't losing as, let's call it, badly as predicted. You saw that bid pick up in the futures market and so forth, as people had gotten maybe caught a little bit off balance, not on the fact that Trump could win, but at the fact that when you saw him starting to dominate some of these states, that's what drew the House and Senate sweep, into a possibility. And you saw futures fly Tuesday evening, and it's really a continuation through there, up until today. We're recording this on Tuesday, the 12th. You've seen reallocation of traders and investors that had overhedged or bet against the market coming in. So it's that exaggeration we really saw on Wednesday, Thursday into Friday of last week. Now we're really seeing just a digestion here as people try to take a look at some of the nuances that you've been discussing and try to position their portfolio.
Great. Thanks, Matt. Let's take a quick jump over onto the fixed income side and into rates and yields. For our listeners out there, part of our active management philosophy in fixed income is to really move the extent of our duration lean alongside our level of conviction. So more conviction means more lean. In our short, intermediate, and total return municipal and core strategies, we've been tactically longer versus their respective Bloomberg benchmarks, albeit less than a year longer, just to balance risk to the uncertainty that we've seen. And the market's really had a lot of whiplash in yields, both prior to the election and since the election. We had a really great rally April to September. We gave a lot of that back in October leading up to the election, as John talked about. The day after the election, we really had a pretty significant move. The 10-year Treasury, I think, was about 16 basis points higher. Then we tightened most of that back in the few days following. And then today you're seeing more weakness. I think the 10-year's down, roughly half a point. Dave, do you think, the market's still trying to work out like its own conviction levels at this point?
Well, I think that's right. As I mentioned earlier, we don't know exactly what the proposals will be from President Trump. Will he go all in for tariffs? Will he go all in on the immigration question, or just partially? And the market doesn't know that any more than we don't. And so the market is moving with rumors. It's going to be tougher, or it's going to be not as tough. And I think we're going to see continued volatility in the bond market until we get more certainty about what the president is actually going to propose and whether those proposals will pass in the form that the president has proposed them in. So I think we're in for a period of a little more bond volatility, not huge volatility, yes, but not big moves from a range of perhaps 4 to 4.5%. But within that range, probably some pretty good volatility.
Yeah, there's been a lot of volatility so far. We've had a lot of short-term movements. I think a lot of noise. At Cumberland, for those that are watching, we like to position for more of a midterm and longer-term view on the market. So, as an example, we think corporate spreads are tight, looking at mid and longer-term data. So, for example, we've underweight that in our 4 core strategies versus their respective Bloomberg benchmarks. That's a tactical move. That's because of our mid to longer term views on where spreads are in corporates. Now, before I ask you, John, about rates and munis, I'll give you the caveat here. I know that there's data coming in the next couple months. I know that the Fed's going to react to that data, and that may change our outlook. But based on what you know now, currently, what do you think the outlook is in 2025 for munis and treasuries?
I think what you have going forward into next year, obviously it'll be data dependent, but we're still looking at an economy that, if the Fed's continuing to cut rates and they're data dependent, that means the economy is slowing. You would think it might be 2 steps forward, 1 step back, but that rates should gradually subside, particularly if inflation starts to come down. One thing that's important in this recent jump up in Treasury rates that we showed was that municipal bond rates were up only a little more than half of that. Corporate bond rates were up less than Treasury rates. And why? We think a lot of it was the fact that the Treasury rate was kind of a proxy for the politics that were going on. A lot of municipal bond issuers front ran their issuance and got it done in September and early October. On a near-term basis, that's quite constructive because you're going into the biggest demand area at the end of the year, December and January, with a lot of bonds rolling over, maturing, coupon payments, et cetera, and not much supply in munis. You're right on corporate. Corporate spreads are fairly tight where they are. They may stay tight for a while, and particularly if you have a corporation-friendly president like Trump. But I do think that the bigger pictures, the things that we have seen, are going to support the Fed continuing to cut rates, albeit maybe at a slower pace than people originally thought this year.
Yeah, I agree. And Matt, kind of a similar question to you, or same vein. We've seen just an incredible run in equities this year. How are we positioning equities into 2025 with, some of the policies that we've talked about, Trump as president, red Senate, very likely a red Congress. What are you doing on the equity side, or what are your thoughts on the equity side as far as the market for next year?
We're not making any wholesale changes, that's for sure. The areas that we've tried to overweight recently, call it the last 6 to 12 months, as you say, we take a little bit of an intermediate time frame when we try to position on the equity side, have been industrials, have been some of the heavies to mix in with technology and growth. And if you look at performers this year, top performers, we've had very solid performance out of industrials, technology, financials. So those areas have worked well. There's not a reason to pull back off of those right now. What we need to try to identify is, does this election, and really the landslide portion of the election, change any other sectors that were previously unloved or overloved? I mean, some of the areas that you saw have some trouble, you would guess what they are in terms of what Dave and John Musso and yourself have been talking about, Ben. Real estate reacting to higher rates and perhaps some higher inflation. Utilities, which by the way have been a very strong sector on the back of technology. Who would have guessed that 5-10 years ago, that utilities and data center construction due to AI would make utilities a hot sector, right? But recently, interest rates have started to pick away at them. That's the old traditional trade, right? Rates higher, utilities down. We saw that shorter term. Does that give an opportunity in either of those sectors, perhaps selling off too much, perhaps getting mispriced? We'll see. We're not long either right now, but as strong as growth has been, maybe that is a way to counterbalance any possible pullback in just an overheating growth market down the road.
Thanks, Matt. So I think, we've touched on 2025 outlook. We've talked about the election. I think this has been a great discussion. Thank you guys so much for coming in and having this chat. Thank you to the audience for joining us at Cumberland. I just want to point out again and stress, we really do take our responsibility to you very seriously. Position by position, we build accounts really to stand on their own, really focusing on building trust with our clients and our partners. So we want to encourage you to reach out and speak to us. We love markets. We value relationships. We want to be your resource. So email or call us anytime. You can use the contact information below here. And thank you so much again for joining us today.